Yes, I'm sorry for the delay. First of all, we had some technical issues, but now everything is working. Everybody is online right now. And let me just give you a little bit of a background, first of all, to this EBI Policy Series. The EBI obviously is an academic joint venture, and we have been doing a lot of academic work in the academic board for the last 4 years already, and also a well-established global annual conference, which is dedicated to academic research. It's taking place every year in Frankfurt and across various countries in Europe. Besides the academic work, we also would like to provide now a platform for a policy debate, which is now more and more ongoing in this particular field, banking and capital markets. And that's why we launched the global series, which took place for the first time in September this year with Eduard Fernandez Bolo. And we were talking about banking mergers and the ECB approach in this regard. The EBI Policy Series is culminating every year in the EBI Policy Conference, which will take place this year in November, where we have, amongst others, Valdis Dombrovskis as a keynote speaker in this regard. Today, the conference will, the EBI Policy Series will deal with the EU Presidency of Germany, and in particular, the program of the German EU Presidency in the field of banking and capital markets. And in this regard, I would like to welcome two speakers. First of all, our keynote speaker from the German Ministry of Finance, State Secretary, Dr. Jörg Kukies, who's going to present the topic to our audience. First of all, just in terms of background, Jörg Kukies comes from Mainz, and he public administration in Harvard, and then made a PhD in finance at the Chicago University. He was working during his career, I think, only for Goldman Sachs, and then where his career culminated as being co-CEO of the German subsidiary of Goldman Sachs. And since April 2018, he's state secretary at the German Ministry of Finance, and he will present us the program of the ministry in this regard. I also would like to welcome very much Professor Roland Koch, who is basically a discussant in this policy series. In terms of introduction, Professor Roland Koch is a German manager in various fields, I have to say. He is chair of the supervisory board of UBS, so very, very familiar in the field of finance as well. But he's also working a lot in the real economy. He's a member of the supervisory board of Vodafone and was CEO of the German building company Bilfinger. Before his career in the private sector, he was a long time politician in the German country of Hessen. He was in the Hessen Landtag for a long time, but then also for 11 years prime minister of the country of Hessen. So welcome to both of you for this policy series. I very much look forward to this. I also would like to welcome you in the name of Christos Gortsos, who is the president of the academic board of the EBI. And he, together with myself, we will host a discussion afterwards. Just in terms of housekeeping, we will have, first of all, a keynote speech of about 15 minutes of Jörg Kukies, where he's going to present the program. Then we will have a short intervention of 5 to 10 minutes of Professor Roland Koch. And afterwards, we will moderate a discussion. If you would like to participate in this discussion via your own questions, we have the Q&A tool here on the bottom right of this WebEx seminar, where you can always ask your questions, and then Christos or myself will read it out. So with these words, I would like to close and hand over to Jörg, please, for your opening remarks. Thanks very much for attention. 1 second, we need to unmute you. Now it should work.
Okay. So obviously, the sort of the pandemic has changed our priorities quite substantially. While in January, February, while we were starting to think about priorities, We had things like Basel III implementation, Solvency II, and other big regulatory issues in the planning. But of course, COVID started delaying all of that, and we had to rejig. And then, of course, the debate around the recovery program and its implementation, which to a large extent falls under in our remit, also took instant priority. And of course, given the finance ministry's responsibility for quite a lot of those policy measures, obviously that immediately rushed to the top of the agenda. And the priorities, needless to say, had to be rejigged. So at the moment, the debate around the recovery facility and the implementation is going very constructively. We had ECOFIN last week and achieved agreement, and that was later then confirmed by co-repair. So the Council now has a negotiating position on the recovery and resilience facility, which I think goes exactly in the direction that was agreed by the heads of state, just in much more detail and very close to implementation. On all of the issues around governance, on the exact method by which the member states submit their programs, by which those programs are approved by the Commission, that are then debated by the member states in the Economics and Finance Committee, and then implemented and paid out according to the milestones. So essentially, we now have the exact plan how money starts flowing on the 1st of January. We are entering into the trialogue with the EP, and hopefully we'll get it agreed quickly. Of course, there are some open issues, as was visible in the press today. The probably most difficult issue is not related to fiscal policy directly, but rather to rule of law. As everyone who read the press saw, some member states are threatening to veto the whole thing if there is no agreement on the exact implementation of the heads of state and government agreement on the rule of law regulation. That, of course, threatens to block the whole thing quite substantially, because while the recovery and resilience facility is qualified majority, in order to implement the whole thing, we need the own resources decision, and that requires unanimity plus ratification by all member states. And of course, that can take quite a while. So there's a problem in principle that there's no agreement on rule of law yet, which is very unfortunate given the importance of this topic. But the other topic is, of course, if there is delay, then we could seriously threaten the positive impact of the measure, because neither can the Commission issue debt nor can money be paid out unless the ratification is done. So that is really the biggest problem. Then, of course, there is still a very substantial debate with the European Parliament, both on the MFF and priorities that the European Parliament wants to have included, and the debate with the European Parliament on governance of the RRF, where the European Parliament would like some more say on the governance, which is completely understandable. But on those issues, I think we will achieve a compromise. So in that sense, that's my very quick attempt at summarizing 3 months of intense negotiation. The other topics in our presidency that we will focus on is, of course, the triumvirate of banking union, capital markets union, and digital union, all of which we are in full agreement with the Commission that they need to be massively prioritized. On banking union, we're making good progress, both at the level of the ad hoc working party, where we're having very intense technical discussion on things like crisis management, early intervention, and strengthening sort of the governance of the framework, but also going into the other things like risk sharing, like risk reduction. Of course, the debate around EDIS is still alive. The debate around risk reduction is still alive. It went on hold for a few months during the prioritization of fighting the corona crisis, but now all all of the banking union debates are back in action. We're also working very closely with the Eurogroup presidency to make sure that the topic of ESM reform, which was also halted, including the debate around the common backstop, is also reprioritized, and we will address that in November, because of course the banking union project and the common backstop project are very, very closely interlinked, as is the debate around liquidity and resolution. So all of those topics, 15 minutes don't allow me the time to go into details, but in the debate we can certainly do that in more detail. Moving on then to the Capital Markets Union, we are very happy that the impulse that we gave more than a year ago with the joint French, Dutch, German Next CMU initiative has really fallen on fruitful ground. The Commission installed the high-level working party, which presented 120 pages of very dense, very good, very concrete, very pragmatic and practical proposals to advance the CMU. And our goal is to use that document together with the Commission to hopefully in the next 6 to 8 weeks get an agreement within the member states, i.e. the Council in ECOFIN on the 1st of December, with the clear mandate to the Commission to start with the legislative work and to concretely implement the 17 measures and proposals and ideas that were set out in the CMU document. And I think they're extremely sensible and extremely good. We did achieve quite a lot of progress between 2018 and 2019 and ended up implementing 11 of the 12 proposed legislative measures by the Commission in the last term of the Commission. So I do think if the European Union agrees that this project is top priority, we will be able to achieve progress. So I do think that we achieved much more than was commonly noted in the public observation. But as a lot of those measures are now being implemented, I do think the awareness that progress has been made on CMU is growing, and more progress is out there to be made on things like information sharing, on facilitating access of SMEs to public markets, on a stronger equity culture across the European Union, on decreasing fragmentation across borders. I think that's a common theme between the banking union and the capital markets union, that this dispersed, fragmented, ring-fenced nature of our capital and banking markets needs to be fixed urgently. So I think capital markets and banking union are definitely sister complementary projects. The same goes for the digital union. End of September, the Commission made very, very ambitious proposals on payments, on crypto, on stable coins, on interfaces of big tech and the financial industry, on level playing field, on preventing cybercrime. There's a very close link, of course, between the debate around digital currencies and the stablecoin debate. And we all agree that this is both, of course, this debate has monetary policy aspects, but it does have complementary fiscal, financial market stability implications. And it's very good that monetary and policy authorities are working very carefully and very closely on all of these initiatives. Whether it is the debate around stablecoins, on cyber, on CBDC, on the European Payments Initiative, all of those are interlinked, intertwined, and are extremely important for the European Union to gain strategic advantage. I do think the European Union has a lot to offer in these areas. The ECB's instant payment systems are second to none on the globe. So I do think Europe shouldn't short sell itself on these matters. We are very forceful, very powerful. What needs to change, and I think that's exactly the same theme as with banking union and capital markets union, is the fragmented nature of our digital markets. A startup that is starting to grow in Belgium, in Finland, or in Germany faces 27 KYC, 27 AML, 27 consumer protection regimes. The Chinese competitor faces much less. The same goes for the US. They don't face one, right? I mean, if you talk to the US, interstate rules are also there, but the capital markets, the digital markets, the banking markets are much, much more unified, which allows the participants in those markets, be it in the capital markets, in the banking markets, in the startup markets, in the fintech markets, the ability to gain much quicker scale. And I think that's the big theme on digital union that we have to address. Of course, the topic of delineation between financial sector and technology firms is one that is extremely important. We are debating that in the context of the lessons learned from the Wirecard scandal, where essentially financial company, through the rules and regulations that we've given ourselves, was able to circumvent the supervision of financial regulation to a large extent. That is certainly something that needs to be fixed very quickly, because this delineation between technology firms and financial firms is certainly something that is not unique to Germany. That is something that we agree with the Commission also needs a European answer. So with that, I'll close. I think I was pretty close to the 15-minute mark, and I haven't addressed the also complementary sister projects such as AML and green finance, but I think those obviously are also priorities and have very similar objectives and themes that the other topics that I addressed have. Thank you.
Thanks very much, Jörg, for this presentation. And I would hand over right away to Professor Roland Koch. I forgot actually before to introduce him also as a professor at the Frankfurt School of Finance, where he's teaching on management in regulated markets. So also a topic quite related to this area. So Professor Koch, I would hand over to you for your counter statement.
Yes, thank you very much. Good morning, and thank you for having me. Just a few sentences, hopefully more than 5 minutes and 10. You know, for former politicians, that's always a risk to speak too long. But I think Kukies showed that he can keep the ability to speak like a finance guy, also being in a political job today. And by the way, I think it's very helpful for Germany at the moment to have a person representing Germany in all these negotiations, which is coming out of the industry. That is a significant different language, and I think that is helpful, because in that what we are discussing here, and the most important thing at the end is pragmatism. We all know, we know a lot about the theory, we know about the needs for financial and the capital markets, we know to implement financial resources after the crisis, but in Germany there is a saying today, nothing is to be good as long as it is not done. And therefore, here, this I think is very critical. First step, I think the signal of the 750 billion package is an important one, not only being able to react in certain areas to the crisis, but also making Europe to a financial marketplace with an additional interesting player. European Union at the end of the day will be the fourth or fifth largest issuer in the market, and we, I think, could see in the reactions of the markets worldwide over the last months that, number one, a lot of people outside Europe were relatively surprised about the capability of Europe to bring up such a program, and number two, the European market, financial market and capital market is becoming more interesting by having the ability to do such thing on a European level. To do something on a European level is the issue also when we are talking about banking and capital union. You know, we had all the steps, we had programs 5 years ago, but until now, it is quite difficult to work with it. In my personal experience, as the chairman of the UBS pan-European entity, so I'm the chairman of UBS Europe, not UBS, to be not in conflict with my friend and colleague Axel Weber. We created over the last 5 years a real pan-European bank in integrating all legal subsidiaries we had historically in Spain, Italy, Luxembourg, or wherever, to one now located in Frankfurt. But the illusion to have one bank after that, of course, is daily attacked by all that what your Kukies mentioned in the last part of his remarks, that we have such a highly differentiated environment, sometimes also on the regulatory base, on the base of the regulatory authorities, but also with consumer protection, also with data protection, where we thought that, for example, GDPR would be a European regulation which is handled in the same way in all the countries, which is definitely not. So to come up to European banks still depends on some fundamental issues where we need decisions, and I think that what the German presidency is doing at the moment with EDIS and others to bring it back to the table, to try to find a solution and a compromise on a time line for the future to make it possible to talk about more details and more pragmatic issues after that is quite important. When Germany and the presidency is failing in that, we have to discuss on the banking level what potential alternatives we can have. So again, my colleague Axel Weber, I think, mentioned a few weeks ago in a conference in Frankfurt, and then maybe we have to talk about different speeds in that to give one of the large European banks a chance to interact under ECB regulation without being nationally regulated any longer, to make sure that they have a chance to merge or to cooperate in a certain way. The disadvantage of Europe at the moment is in the size of our institutions, and it's of the size of the market. Size of institutions is caused by the question whether we can have better regulatory systems on the banking union side. And we can come up with pragmatic steps to go nearer to that. When we are failing to go a significant step forward, I think Europe has to start to think about alternatives for a certain time to buffer the political decisions and to make sure that we don't lose too much on the market capacity worldwide. And that's also, and that may be the last point, on the capital market side, where again, we have to talk also about pragmatic issues, which are on the table. Who is entitled to deal? How do we cope with the fact that London is missing in the market in the future? But also, I think in the MiFID-related regulation, for especially us in Germany, we maybe overstressed the issue of how to manage research. And we have now a real difficulty for small and medium entities in Europe, whether we can do some research bundling again. I know that is on the table, and that's relatively significant for Central Europe and especially German companies to get access to that capital market and to make the capital market of Europe interesting for those who are coming from outside, because the potential lies in that. So I think we have to make sure that hopefully Jörg Kukies and the team has enough time beside managing the crisis, which is a real challenge, because at the end, crisis management has always priority. But Germany is one of the very few countries who is fully in the experience and the dependency on financial and capital markets. So when the German presidency is not successful in setting the targets for the next years, we cannot wait for others who are less interested in that than we are. And therefore, this is a very important time beside the crisis management. And I'm very, very happy to hear from Jörg Kukies about the steps that he described, that although that is on the agenda and has to be on the agenda. Maybe that is a first comment from the more practical way of that what we are discussing to the politician. I like to have that role today, and happy to discuss. Thank you.
Thanks very much, Roland. And then I would suggest we enter the discussion. I would like to remind also the audience again, they can ask questions as well in the Q&A tool. Then Christos and myself will read them out aloud to each of the panelists and discussants. Let me start with one question addressed to both speakers, talking about a similar topic, but from different angles. Jörg, you mentioned essentially the topic of banking union and the importance of EDIS. The ministry has made a proposal last year that you reiterated how important it is in order to make progress on banking union to also have, for example, things like EDIS and the common backstop. One of the requirements that you set out, or the ministry set out in this regard, was also risk reduction. You mentioned this in your presentation again. risk reduction in the form of different regulation, but also risk reduction in terms of absolute risk. And I guess, let's say the European banking system has made quite a lot of progress in terms of reducing NPLs, for example, in the last years. However, the crisis obviously is indicating that the train is probably going now into a different direction when it comes to NPLs. That's quite obvious. So does this mean for European Banking Union and EDIS that this will be postponed because risk reduction is not sufficiently possible at the moment due to the external environment? Or how do you see progress made in this regard? And I also would be interested essentially how these negotiations are going on. And then afterwards, I would ask a question to Roland Koch in relation to European banking market and the importance of EDIS in all of these different institutional setups and concepts. Yeah, from a, let's say, industry perspective, how important are these in order to create this European market? Or if I would phrase it otherwise, the other way around, do you create a European banking market just by having a harmonized regulation, or is essentially also the differences in individual banking markets still continuing to persist in order to be a hindrance to a European banking market? Or how can this be overcome? You're working leading a European bank based in Switzerland, of course, or in Germany when it comes to the European branch. But do you create a European banking market just by means of regulation, or how can you overcome other obstacles in this regard? So I would start first of all with Jörg in relation to the first part of my question.
Yeah. So on risk reduction, I think, I mean, given the long-term nature of the banking union, I don't think one cycle will derail the discussion, because we all know if we agree on a banking union, it will be we'll need to find a framework that goes way beyond the current crisis. NPLs are always lagging indicators, so in that sense, I think it's very obvious, given the depth of the crisis, that there will be an increase. But at the moment, I think all of the data that we're seeing is that the banking system is able to deal quite well with the current situation because of the capital buffers that have been built up over the last years. So in that sense, I do think there is quite a lot of resilience in the system, and all of the financial stability reports that we're getting does show that what the banking system has built up over the last years is really helping at the moment. There is one caveat. I do think that, during this crisis, some of the problems that we have increased rather than decreased. NPLs, of course, is potentially one of them, and we have yet to see the impact. However, if I see the policy response, we're addressing that quite well. The European Commission is working on the NPL program and doing what it can to facilitate governance and reduction of NPLs, and incentivizes banks to do that. So I think that's going in the right direction. On the bank sovereign nexus, I don't see a lot of progress yet. And if anything, I mean, it's obviously, it was correct for all of the member states to avoid the credit crunch in their respective countries by instigating loan guarantee programs for their respective promotional banks. We did that with KfW, and France, Spain, Italy, others did that with their respective promotional banks. So I'm saying the policy response was correct, but we also have to take into account that, of course, the bank sovereign nexus, if anything, has increased through that, and it makes methods to intelligently address that in the future all the more necessary, because I would say while we have seen quite a lot of legislative work on NPLs, we've seen nothing in terms of reducing bank sovereign nexus, or very little. So in that sense, I do think that's an issue that still needs to be addressed in terms of risk reduction.
Thanks very much. Dan Roland?
Yeah, okay. I agree with that. Asking the question, what do we on an industrial side need, or what can happen? So why is EDIS important? The answer is a bit with the history of UBS here, to say we could merge European banks to one legal entity with a certain amount of really integrated systems, because we are not a classic retail bank. When you're talking about investment banking, or when you're talking about wealth management, it is easier than when you are really on the ground with commercial loans, with retail loans, and with all the other retail business. When you want to really merge banks, but they need also in a worldwide context, you need to have large banks which have also retail business on the ground. And as long as the deposit insurance issue is not solved, it will be extremely difficult to really do a merger. Because, well, to have two legal entities now owned by one theoretical legal entity in the country is not the solution. We are talking about integrated model of banks, which can really leverage the whole capacity of scaling. And that is in Germany, is in Europe, and they're in Germany at the moment impossible. So everybody who wants to have competitive European banks has to solve that problem. And I think that's also a message to Germany and in Germany, who is one of the relevant players in this EDIS issue, that looking to the place of Frankfurt and all that, what also your Kukies is very often discussing with the banks we have here, when we're talking about scaling and merging banks and bringing them together, at the moment, it may be like a poison pill. And to have that, but that's not the answer. That's not what can create growth. And therefore, I think it's really relevant to get steps forward. And the question, of course, is, and I, as a former politician, I know very well what to say, that at the end is a question which very much depends on Germany and the steps ahead. And so I think the German question is, when in the NPL sector, a lot of things are done. Number one, 40% down since 2015, and having a very significant better capital situation than before the last crisis. So both parts are coming better together than ever. But we will not get any relevant answer for the bank sovereign nexus at the moment. And the other question, how can we have an agreement of the European states how to cover that, having a common deposit insurance system? So there is a nexus, and both has to be discussed, but I think the Germans have to find a way, and I think indeed the Germans have to find a way to offer a path which can enable us to come to the European structure in that. Or there are a lot of other issues which still will remain when you talk about capital markets. For an example, of course, Europe will have different taxation systems also in the future. The question is, can Europe agree, for example, in a withholding tax scheme in a certain way that banks can operate with that all over? But when you are living in Spain, you have another kind of managing wealth in CCAF structures, which Germans really don't know. And that's a bit culture, that's a bit tax, that's a bit existing market and financing of companies. So we have a lot of things which we have to appreciate also in the future from our, in respect to our clients. But that's manageable. When the basic legal structure and the basic regulatory structure is in a way that we can start scaling, then we can find solutions inside to organize it. As long as it is a no-go, you will have growing American banks and you will have growing markets in the other places, which are really dangerous. And maybe the last sentence, living in a structure where indeed a Swiss-led worldwide bank is there, when we are talking about growth opportunities, we always see what's happening in Asia. We've seen what happened in the US and what happens in Europe and what are the potential growth perspectives. And when all with the growth perspective in the European market is relative to the others lower than that, that has consequences for investments in the future. Whatever you try to do and however you honor the European market as a very important part. There is no time to discuss that in 5 years, because there are a lot of decisions made over the time where market growth perspectives and revenue perspectives are best, and therefore it's needed to come a step forward.
Thanks very much. Then, Christos, I would hand over to you for the next question.
Thank you very much, Thomas. And on my side, let me also thank you for having accepted this invitation to participate in the event today. I will extend the discussion on a related topic, which is the creation of the common backstop. Mr. Kukies, you mentioned that at the beginning, yeah, but we can develop on this. Maybe this is a more important missing element of the completion of the banking union, especially nowadays, given the increase in the NPLs across the board in the European Union. So my question is, number one, what is the process that you can foresee with regard to the establishment of this common backstop to the SRM for the Single Resolution Fund? Yeah, just in case large banks need to be resolved. And the second related issue refers to the discussions concerning the creation of a bad bank, of an asset management vehicle at the European level. If you allow me, for both of you, if you could provide some kind of a cost-benefit analysis of such an endeavor, which is not a straightforward exercise and entails a lot of risk. Thank you.
Good. Government is always first.
I mean, the good news on the common backstop is pretty much everything is negotiated, right? I mean, we literally have documents that are ready to sign, that have informally been endorsed and that have all of the details up to the treaty level, up to the implementing level, the governance decisions, the fee decisions. Everything is pretty much done and dusted. We just need the Eurogroup to endorse it, finalize it, and give it free for ratification. I mean, it's public information that Italy has a difficult discussion domestically on this topic and no agreement at this point. But generally, the decisions of the Eurogroup are pretty much ready. So in that sense, if and when there is a consensus and that everyone can then sign the documents, we don't have much to do anymore in terms of negotiating. They just need to be ratified in the member states. The open question that is to be addressed afterwards then is the question of front loading of the common backstop. Do we move it ahead in time sooner than the envisaged implementation date of 2024? And that depends on a risk assessment. The authorities are going through those risk assessments at the moment, and we're going to have a debate in November about that. And of course, the two topics of ratification of the ESM treaty, implementation of the common backstop, and moving it ahead are very, very closely linked. It's very clear that without the decisions on strengthening the governance of the ESM, without implementation of very important elements in the negotiation, such as single limb collective action clauses, which would make the restructuring easier if and when it's needed to be done. All of those things that have already been consensualized between the finance ministers in the past need to be implemented. But I think if we achieve this in November, and the Eurogroup president Donahoe has announced that he will make a substantial effort to conclude this by November, we really could have a big impulse for the banking union. So I think this has some upside potential for positive surprises if and when it happens. The way the common backstop is structured right now, it will be universal. So if Europe agrees on implementing it, it will be implemented with no exceptions to member states and or financial institutions. So either it applies to everyone or it doesn't apply at all. And I think the method through which we negotiated this is a very stringent one. And if we get it done, it would really stabilize the financial system more.
There is not much to add. I think also that coming to a consensus about the backstop issue and the ESM treaty is an additional important signal to the world that Europe is really willing to create a common market on banking and capital. I think some people in Europe were surprised about the reaction, also currency-wise, the reaction of the decision of the European Council, the crisis reaction with the 750 billion program. That is much more appreciated than also being evaluated as an economic issue. It is a political issue whether the European continent has the capability to make decisions to create a real market. And in that sense, I think the only open door we have at the moment is this ESM and backstop issue. Politically spoken, it's obvious that it has to be at the moment an Italian issue, which has relevant impacts. It is more or less a German issue, which has a relevant aspect. And therefore, the question is whether the heads of state are able, beside the crisis, to come to some conclusions, or because of the crisis, come to some conclusions. For me, it is sometimes underestimated that all what we're doing at the moment, the crisis management issue, is nothing more than a starting point. Let's assume we do that well, and there are good reasons for thinking there are a lot of predominant decisions at the moment, also in this 750 billion package, which enables business, society, science, governments to do significant steps in future economic developments with that. But then you need the other resources. So it does not make sense to establish state-funded venues in Europe when you are not attractive for international capital. The starting point has to be funded at the end of the day. And therefore, I hope there is a certain kind of consensus at the head of states that at the end, Italy has to pay a price for being a real effective member of the European Union, also in financial and capital markets, and to be honest, Germany also.
Thanks very much. Then, if I may add now another question on the topic of the safe asset. Jörg, you mentioned this already in your opening remarks. This is also always a very controversial topic, also in connection with the banking union. And when it comes to this issue of breaking the link between sovereigns and banks, I have the impression there are always two schools of thought. Some think EDIS is the only solution in this regard, and then other countries more in the north think a regulatory change is also required in order to essentially disincentivize a little bit the pure investment in your own sovereign. So we have now these commission bonds to be issued in a significant amount. Is this enough in order to, let's say, break this link, or do you also kind of disincentivize banks to purely invest into their national sovereign bonds? And I would also like to extend the question to Roland. I mean, obviously, from a business perspective, regulation is one thing, but obviously the yield of a particular bond is another as important issue for an investment. Is this enough in order to break this, or will we continue having this strong link between a bank and its sovereign?
Well, I think the 750 billion program of issuance by the Commission, plus, of course, quite a lot of the additional issuance through, for example, the SURE program that has been agreed to help to finance unemployment, short labor, and qualification in the member states. That's another, it currently stands 87 billion euros. I mean, that's a safe asset at the end of the day, right? I mean, it will very likely, depending on the exact own resources decision, the 750 billion program will be likely to receive AAA rating. You know, it's debt issued by all member states. It's not joint and several, but in our view, that is okay, because the guarantee structure of common debt issuance with the own resources increase of the ceiling by 0.6 is more than enough, in our view, to be characterized as a European safe asset. So in that sense, it's up to bank treasuries then to decide whether they buy this or not. But at least now, a very, very substantial volume of what can be credibly called a European safe asset is available. So in that sense, in addition to ESM paper, in addition to EIB paper, we are getting more and more European level, very, very highly rated paper that's available for diversification of banks and to break the bank sovereign nexus. So in that sense, we also think that it would be appropriate to induce this switch into more diversified bank treasury holdings by regulatory and supervisory change, because of course the availability of the product now makes it feasible and doable to actually make this regulatory change. And that, of course, would help then on the other side address some of the concerns that other member states have on more risk sharing. So I think it would be a win-win situation if we agree to a comprehensive program of more risk reduction and more risk sharing.
Well, in a very general way, banking industry, for the banking industry, it's easier to manage a change in this bank sovereign nexus issue than it is for some of the relevant countries we are talking about. But it is not easy. It's a long path, and therefore nobody had ever the idea to stop that from one to the other day. Only question is whether do we start walk along a path which will end in the next generation, or do we ignore systemic risk, which is by having such a financing structure for unforeseen long time ahead. And talking about that, indeed, the actual program, as Kukies says, is helpful to diversify on the bank treasury side. So having said it's easier for us than for the states, now it is indeed a step easier for us. Is it also easier for the states? That has to be seen. Are they more relaxed than that now, having this facility, knowing that that is also an ending facility, not an endless new structure like Eurobonds, but it is helpful for them to disconnect in a certain way when that is combined with a very, very careful path in the new direction. For me personally, at the end, it's a precondition because it's an insane system we are having here. And we know that. We know our restrictions to act at the moment because we have that system, and we have to make it easier for the next generation to work with that. But I'm still very doubtful whether in democratic systems, in these countries we are talking about, like Italy, the government really will be successful in starting as careful as possible to go in that. Though it's a very risky point in the discussion, but it's still important.
Thanks so much. We have 6 minutes left. So again, to the audience, if you have questions, the Q&A tool is available. Then I would hand over to Christos again.
May I?
Yes.
Very briefly on the Capital Markets Union. One aspect which is important is that during the last months, several of the pillars of the Capital Markets Union have been completed, including those concerning sustainable finance. But yet, delivery in some fronts is not as efficient as expected, especially with regard to the financing of SMEs. I'd like to have a comment on this. And a second pillar, which obviously will not be the case during the German presidency, potentially during the next one, in I don't know how many years, is about the need to centralize capital markets supervision at the European level. The banking union, at the end of the day, is about a single supervisory authority. The capital markets union is not about a single supervisory authority. So if there is any comment, potentially, have Mr. Koch on this. Thank you.
Yes, so I would partially disagree because we did in 2019 implement the so-called ESA review, the review of the European supervisory authorities, and we did give additional supervisory powers to IOPA, to ESMA, to EBA. So in that sense, I somewhat disagree that there's no progress yet. Of course, it's the eternal debate around glass half full, glass half empty, around whether it's sufficient, how much additional power has been given to, particularly to ESMA. So in that sense, I think that's something that will continue to be discussed. The German government has just passed an action plan as a result of lessons learned from the Wirecard scandal, where we have said that we do envisage a stronger role of the European Union in supervising financial market activity, with the aim of thinking about whether the SEC provides a role model for that. So the willingness is there, but the point that you address is a very subtle but extremely important one. If you ask politicians and policymakers on whether they agree with the concept of capital markets union in the abstract, everyone will say yes, or almost everyone will say yes. If you get to the minutiae and the details of the individual policy responses, the view is much less clear. So I think that is really the issue of having the courage and braveness to delegate national supervisory authority to the European level, which simply will take time. Whenever I traveled to the US, when it was possible to travel to the US, I always stop by at the FDIC, and if you listen to the century-long progress that it took from the first establishment of the FDIC in the 19th century to actually having a full-fledged, working, functioning banking market in the 1990s, with the elimination of restrictions on cross-state banking, you know how long it can take, right? And I think this gradual move toward delegation of supervisory power to the European level is something that is simply not easy. And of course, one of the big problems is level playing field, and that's something that we want to address. But it is also included in the CMU package by the Commission, so I'm optimistic that we'll make more progress on that.
Well, my position is we have to look on both angles. The one is the general approach to a capital market union, and the other, as I mentioned before, is looking to the details. How can we strengthen in between? And that is very much along with that what your Kukies says. We will not have the creation of a capital market union and the size of Europe from now to tomorrow, even having a German presidency. This is a long period, as it is a bank sovereign nexus. We have to think in long terms about that. But the question is, can we have things we can start now? And what is the issue? Number one, we need people in Europe who want to invest more in the capital market structures. We need people from outside being attracted from the European capital market, and we have to have facilitators which can scale their business in a certain way. So indeed, we need to transfer more to ESMA when it is possible, and as easier is it to scale. Number two, we have to organize attractive points of access to Europe, which is, after having an open debate about Brexit, an issue which is more crucial than a lot of people in public saw at the moment. Maybe nobody is talking about that offensively, because everybody is hoping that there will be a Brexit agreement, including the financial industry. But whatever that agreement is, or it is not, the exit issue is much more important than I think it is at the moment addressed in public. And the third part is, we have a lot of resources in our own world. Talking again about Germany, we have a pension scheme which is not able to really provide the resources, the necessary resources, to the capital markets. but in the capital markets, it is the only resource which can generate the revenues necessary for the next generation. So the system is not correct at the moment, and it's our internal issue, starting in the Federal Republic of Germany, in some time now also maybe in the European regulation we had about insurance companies to manage that. We have a way to consumer protection in Europe, which does not separate sophisticated, more or less professional clients to others, which of course slows down the process of being invested in the European market, and these same people are invested in other markets because they have the capacity to do that. And the third point, just again, because I hope there will be a change, we need to unbundle research in a certain way that SMEs can come back in the market they lost over the last 2 years by a wrong regulation. Or by an over-sophisticated regulation, and we need a relevant threshold for that. I know that the Europeans at the moment thinking about bring a threshold of 1 billion. I'm very skeptic that that is correct, but we have to do that. Though there are a lot of resources actually there which can be enabled by less than a new structure of whole Europe. And I think we should have that in mind when we're talking about capital market union, because I agree with your Kukies about the long-time perspective, but that's not enough. The capital market is too weak in the international competition, and it can be stronger even if we have not just from one to the other moment, one European capital market union.
Thanks so much, Roland, and also to Jörg. We are now 2 minutes past 11. I know that Jörg has to run right now. Unfortunately, we have now some questions in the chat box, but I think I can pass them on to you later on or after the conference, and maybe have some time to answer them. I would like to thank both of you for participating in this policy series. Thanks very much again. Also, thanks to the audience for listening in. The next event will be the policy conference in November, and you will receive a separate invitation in this regard. So thanks so much and have a good day. Bye-bye.
Thank you. Bye-bye.
Yes, well. Goodbye.
Thank you. Bye.
Goodbye. Thanks. Many thanks.
Bye-bye.